And there you have it. The markets are officially closed on this Friday, March 7th. Welcome, investors and traders. I'm AJ Monte, and this is a daily candle chart of the Dow Jones Industrial Average ETF, ticker symbol DIA. If you had a chance to listen to my midweek report, I did say that there was a good chance we were going to bounce and possibly move up towards these moving averages. And today we had a nice bounce. You can see from this daily candle chart, we have a bullish engulfing candle on higher volume. And down below, you could see that we have a cross on the stochastic. That's a buy signal. We have a pivot forming here on the CCI. That is bullish. We do have a gap now that is officially filled from Wednesday. That is bullish because 80% of the time when gaps fill, we then get a reversal, most of the time, 80% of the time that is, in the opposite direction. So with that, we also have that wide divergence from the moving average. If you did not get a chance to watch my midweek report or last week's report and you're brand new to this channel, I would suggest you go back and listen to those. They're very short videos. And we use these as building blocks to help the audience learn how to do things like draw role reversal lines or how to use ABCD patterns and how to trade the gaps, how to use moving averages and such. And so I do believe we're going to move up, and there is a chance, now don't hold me to this one because I think we will move up, but there is also a chance we could get up to this target up here, which is 440.82. I know that looks a little aggressive, and I'll show you why later when we look at the 200-day moving average. And this might seem a little odd for some of you because I'm long-term bearish, but when I go bullish in the short term, I am using option trades to capture profits on these bounces. So keep that target in place. I think we'll definitely get up towards this moving average because you could see that the moving average is still going lower. And a lot of times you get that rubber band effect where once the price gets back up to that moving average, you get the pendulum effect and it goes the opposite way. You see that it happened back here in January. Now, I'm not saying we're going to rip through and break into new highs. It's not where I'm going at all. But I do think that we're long overdue for a bounce here. Looking at IWM, you can see that we've got a bullish engulfing. Let me magnify that for you. A bullish engulfing that is also doubling as a hammer candle. A hammer candle is a small body candle like you see here with a long shadow under that candle that's at least 1.5 to 2 times the length of the body. Now, ideally, in the textbook hammer, you don't have any shadow on top, but I'm looking at this as more or less hammer-like, okay? I treat those long shadows under the candles as bullish signals, and the long shadows above small body candles are more bearish, like you can see back here in January. Okay, so IWM, I'm still keeping that upside target right there. Let me get that up for you at 219.08, 219.08. Moving on to QQQ, which is basically the tech sector. You can see we have this long shadow right there, and guess where it winds up? Right at that support level right there. You see that? Now, if I back up just a little bit, you're going to see that not only is that a support level, but that's a role reversal back here. Former resistance right at this point here was broken, and then it turned into support here. So that looks like it's going to hold this support. Now, looking at that chart, just going back, you could see that the stock does not like to stay that far below that moving average without snapping back. I believe we are in the early stages of a bear market, but even in a bear market, we generally get bear market bounces or bear market rallies, and this one could be one of those as well. So again, I'm keeping my upside target on QQQ for 514.81. Looking at SPY, which is the S&P 500 ETF, it's very similar. Look to the left as I draw to the right. Resistance, resistance broken, held as support here. I'm drawing that straight out. That is a support level. Remember what the role reversal looks like in that textbook example I give that to our viewers all of the time, again, because I teach through repetition. Okay, so you have a bullish engulfing candle here with that long shadow. You do have the oscillators going up. We have the wide divergence from that moving average, and we're bouncing off of this key support level. So, for it to get up to 598.22 is not too much of a stretch. I do think that this area here in this red dotted line could act as a role reversal of resistance, but we'll have to take one step at a time. In fact, now that we've hit that target, I'm going to remove that line to clean the charts up. I like to do that. If you look to the left, you'll see that all of these diagonal lines here are former target lines that I draw usually on the weekly market report on Fridays. So we hit this downside target. Took a while for that downside target to hit, but we did. Hit the upside target, downside target hit, upside target hit. You get the point. And so back from October, we have 100% hit rate on our targets, and you could see that this is the only target left open, and I do think that there's a good possibility we could hit that and keep in that 100% track record. All right, so that's SPY. Now looking at the VIX, very interesting. Again, today we tested this target up here, which is around 27. Now that was an extreme target. If you recall, I held that target even when the VIX was trading here, down here around 14. So it's up 13 points from the lows here. And today, look at that. The high was 26.56. We missed that by 44 cents. I think eventually we will. But before we hit this upside target, which by the way is going to be up here at a resistance area, I do think that we could pull back on the VIX and even go so far to hit this downside target that I still have open at 1851. Take out your trading checklist, and again, you could see bearish signals here with the long shadows on top. That's a bearish candle. We got the wide divergence. We've got the cross on the stochastic with the sell signal, and we're very close to a sell signal on the CCI. So again, keep your eyes on the charts. Turn off the television. Turn off the financial programs. All they're going to do is try to get you to buy, even when the markets are turning into a bear market. Now, what I'm going to do to keep this video from going on too long is I'm going to jump right into the 200 period moving average because I want to show you what's happening here. It's very, very interesting. This is a long-term 20-year daily chart of the S&P 500 index, SPX. And I want to show you what I think we're going to see in the near future. I think we're going to duplicate this bear market down here and possibly even exceed it to the downside. And here's why I say that. Many of you were following me back in 2021 when I called the top back here, and we saw the markets move down below that 200 period moving average right here. I'll magnify that for you right there. And what happened is we did a slight bounce, and then the moving average became resistance. It became very hard for the price action to stay over that 20 period moving average. And then when it broke out below and stayed below here, that moving average did a role reversal of its own and held as resistance here, until we broke out of resistance, and then it went back and held the support, and I think it is still holding as support. But in the weeks ahead, I do believe the S&P is going to drop down below this and form this, what I call the kiss of death. I know that sounds morbid. I was talking about this with our equity traders yesterday. And as the price starts moving below the 200 period moving average, the moving average is going to start doing this. And then it fails to get over, and then the moving average stays as resistance throughout the bear market. Another thing you want to pay very close attention to is the moving average crossovers. What do I mean by that? Well, on this chart, I have the 20 period moving average, which is blue. The green is the 50 period moving average. The red is the 100-day moving average. And then the charcoal gray is the 200 period moving average. And you can see here, as I magnify that for you, The 20 period is now dropping below the 50. Once the 50 drops below the 100, you're going to start seeing some of the algorithms lightening up on positions with some sell orders coming into the markets. Now, again, I think we could see a little bit of a bounce off of that 200, but I think it's going to fail to get back up over this very concentrated area of resistance. And that would be very similar to what I just described as the kiss of death. That's my own term that I put on that, because it's a role reversal in the major moving averages. Now, if you look at IWM, which is going to look very different here, you see how the moving averages started crossing one another right here, and then the price started dropping below the 200 period moving average. Now, what's happening here in the small cap market is the 20 period, the blue, is now dropping below the 200. That is most likely going to draw the green line, again, the 50, down below the 200. When the 50 crosses the 200, that's called the death cross. I know there's a lot of death going on here, right? But that's exactly what it's called. When the 50 crosses above the 200, it's called the golden cross. So again, what happens in the major markets when the death cross happens, and that's the 50 crossing below the 200, the algorithms start to sell, the money managers start to sell, the fund managers are mandated through their prospectus to sell, and then that adds more pressure. And now we're in to the full-fledged bear market that I'm talking about. So keep your eyes on the charts. We're doing our very best to teach the public how to read these charts so you don't have to rely on anybody. And if you want to become a free member, it's very easy. Just go to our website, send us an email, tell us you want to sign up for the 15-day membership, or I'll put the link in the description box below, and you could do that. It'll be a little bit easier. And then all you have to do is hang on and watch what I do in the webinars. It's absolutely free. You don't even have to call us or contact us to cancel the membership. It just drops off after 15 days. So we don't put anybody in an uncomfortable position to have to do anything to cancel. Of course, if you want to continue the membership, you just let us know. But there's nothing you have to do to cancel. It's just 15 days and then it expires. So you have a great weekend. I hope you're enjoying these videos. Please like and share, and above all, comment. That really helps the algorithms put us on the menu on YouTube, and we get a lot more eyes on our videos. So thank you for doing that. We really appreciate it. Have a good weekend. So long.
In a world of endless data, where every second counts, introducing Nod Live, your professional compass in the chaos of the stock market. Nod Live cuts through the noise. Stay ahead with Nod Live.